Hi, Melissa. How are you today?
I'm doing wonderful. Thank you.
Good, good. So I'm Misty Cabaniss, and welcome to my YouTube channel, Live, Earn, and Play in Central Florida. And today I am with Melissa McGlinchey, who is with Premier Mortgage Resource. And we're going to talk about some fun things today, like DTI. And what the heck is that? So that's debt to income ratio. And Melissa's going to help us out with kind of getting our ducks in a row and understanding this. So, Melissa,
All
what
right.
is debt to income ratio?
Great question. So, debt to income ratio means the ratio of debt compared to your total gross income. So, number one is we use gross income when we're calculating debt to income ratios. There's two ratios that lenders will look at. One is considered a housing ratio, which in our terminology we call a front end ratio. That is the ratio of just the prospective house that you're looking at purchasing. So, what is the ratio of the debt for that home? And that includes principal, interest, taxes, insurance, and HOA. Okay, all of those items together. What's the debt ratio for just that home compared to your total monthly gross income? Front end ratio. So then the other ratio we look at is called a total ratio or a back end ratio. And that back end ratio is the total debts that you have, everything together, the prospective new house, plus all your other debts that would be on your credit report, such as auto loans, credit cards. We do not look at your food expense, your gas expense, your taxes, your electric. So not those items. We're only looking at your actual debt that is reported on a credit report when we're looking at your debt to income ratios. So that total ratio, which is your back end ratio, would be everything together for just the debt with your total gross monthly income. Make sense?
It does make sense. So, basically anything that has to do with, that gets, like you mentioned, gets reported to the credit bureaus, TransEastern, Equifax, and what's the other one?
TransUnion, Equifax, and Experian.
Experian, yes. So yes, all the things that get reported there, that yes, that does make sense. So ideally, where should your ratios be at?
All right. So ideally with good credit, you're wanting your ratios to be no higher than 45% total debt. Okay. And that's all your debt added together. Now, there are programs where we get higher ratios approved as long as you've got a good credit score in order for us to have those higher ratios approved. But want to make sure that when that takes place, that the lender is always running automated underwriting. Anytime that you go over that 45% debt to income ratio.
Okay, so yeah, you mentioned the word credit. So we should probably talk a little bit about that and what that means on an individual basis.
Yes, yep, absolutely. So when we're talking about credit scores, a lot of people will say, well, what's a good credit score? Or my score is not so great. And everyone's definition is different. And honestly, depending upon the times that you're in at that particular moment, will also vary depending upon what's a good, what's a great, or what's a fair credit score. In our current market, it's kind of changed a little bit.
Yeah.
So right now you're looking at good credit is really anything over 700. Great credit would be anything over a 760 credit score. Used to be back in the day, I would have said, oh, good credit is, anything over 680 and great credit is anything over 720. So we've kind of, increased those levels a little bit recently.
Mm-hmm. Yep. So what are some things, what are some things that people need to know? Can I get approved with a no credit score?
Yes, great question, because I am asked that quite a bit. So First, let's
So am
talk about, so are you. Yeah. So the answer to that is a yes. But of course, there's always stipulations that come with that yes. And this is where a really good, knowledgeable loan officer comes into play, because that loan officer needs to understand underwriting guidelines and know those underwriting guidelines. So a good rule of thumb would be that if someone is over a 700 credit score and they fall within that 45 or less percent DTI, almost a no-brainer, okay, that as long as they have the funds and that DTI and 700, that they're going to get approved through automated underwriting. I always run everybody through automated underwriting. It is a nationwide system. I don't have anything special that any other lender doesn't have when it comes to that, right? We all utilize the same automated underwriting engine. However, anytime that you fall below 700 credit score or you have higher DTIs, you really need to run that automated underwriting for a borrower. Now, here's the thing. A lot of times people will advertise no minimum credit score required.
Right.
Which is great. Yes, there are programs where there's no minimum credit score required, but guess what? There's stipulations that come with that. So you have to look, we call those sometimes compensating factors, okay? So when someone has a 0 credit score, we can still get them approved, but it has to be underwritten by what we call a manual underwrite, okay? So when we run them through automated underwriting, they would need what's called an approved ineligible, which means it's approved. The reason why it's ineligible is because they have no credit score. So we have to manually underwrite them. And when you manually underwrite a file, you have to look and ensure that they've got the now lower ratios that are required, along with any compensating factors that are required due to it being a manual underwrite.
Okay. So what are some things that people can do to increase their credit score? Because I get asked this, all the time. And the number one thing that I hear of people is, oh, I'm getting my income tax and I'm going to pay everything off. And I'm like, no, don't do that, because there's a method to the madness on doing it. And you want to hold some credit, and not all credit is considered equal. And, some forms of credit report monthly, some report, every 6 months. And so you want to kind of navigate through that the best way it's going to help you in the shortest amount of time while you're getting everything together to purchase a house.
Yes. So first and foremost, I agree with you with exactly what you said. I like for people to go ahead and apply and complete an application now. So then this way I can look at their credit. And I can help advise them, like, how are you going to get the most bang for your buck? Okay. It's not paying off all your debt. So you really don't have to do that to get the most bang for your buck. We have built in with the credit company that we pull credit with, it's called a simulator. Hello, a simulator. All right. And it stimulates credit.
Yes, it will. Get your blood going.
So what happens is we can actually look at that simulator and see, how does someone get the most bang for their buck? 9 times out of 10, the number one rule of thumb is kind of what I call the 30% rule. Okay. So you want your utilization of each item to be below 30% of the high credit limit. So for an example, I have a credit card and my credit limit is $1,000. I would want my balance to be no higher than $300 on that credit card.
Right.
Okay. So that's kind of where we're seeing a good rule of thumb. Now, it's not exact. Okay. There's not an exact science, but these simulators work really, really well. When people do what we advise them to do, 99.9% of the time, their score gets better and gets to where that simulator is telling us that it should get to. But there's definitely other things that they can do as well. That 30% rule is a great initial rule of thumb to go off of, to look at, to see where your utilization is at for your credit cards. But there's also collections, right? Look at the recent collections that you have. But again, as a loan officer, I'm going to look at that and say, is it a collection that really needs to be paid off or not? Because sometimes they're not needed. Okay.
Yeah, actually, yeah, good point. Because I actually just had that happen with someone. So a lot of times there are things unbeknown to people, unbeknown to them, that's on their credit.
Well, unbeknown to them, but also in their mind, they're thinking, I've got to pay it off. I have to pay it off. Well,
Right.
you might not have to pay it off. That's why it's a good idea for us to review your credit together beforehand. Okay. When people say, well, I'm working on my credit, I want to fix my credit first. Well, how about if we look at it together and then I can help advise you? I mean, being in this industry for over 25 years, there's things that I might know that could benefit you, right? On assisting with that. Big one, no late payments in the most recent 12 months. Okay, that's really big. I tell a lot of people, get set up on auto debit. Auto debit your minimum payment requirement, and then you can just go in and pay additional principal when you want to. Okay.
Yeah.
People will tell me, well, I don't do auto debit because I want to pay the amount that I want. Well, that's great. But in this busy world, right? We're a world of busyness. Things can get past us accidentally. So do that minimum payment and then go in when you have time and pay the additional that you're wanting to pay. So the last thing that I'll say is a good rule of thumb to try and have 3 open trade lines, a minimum of 3 open trade lines with no negative history in the most recent 12 months as well. Okay.
Yes. One of the things I like to tell people, well, you brought up an excellent point as well, is, if someone follows the instructions that we give them, then we can get them to, to the point to be able to purchase a home. And also, it doesn't matter when you're thinking about buying, whether it's 30, 60, or 90 days out, the time to start is now, because like we both mentioned, that maybe maybe there's something on your credit that you don't know about, or maybe there's, a certain way to go about doing this that you're not aware of.
Yeah, there's multiple people that I work with for months before they end up purchasing. I've got one lady right now. She's doing amazing. She's doing everything that I recommend for her to do when it comes to her credit, trying to get her score up there and qualify for down payment assistance. And she's almost there. And we've been working on this for over 4 months now.
Yeah. Yep. And sometimes, like, some people are right there and they don't even know it. And they just have, kind of what's a limited belief and thinking that, I can't purchase a home. And with some, advice from someone like you and a few steps on their part, and they really are ready. I mean, they could be at the part where we could actually start looking for a home. So that's why it's so important for someone to get with you, Melissa, in the very stages. Let's not put the cart before the horse. I know it's all fun going out and looking at houses and things like that, but we want to, you and I, we want to set people up for success. So, you don't want to fall in love with a house that you're never going to be able to afford. And the worst part is for have somebody fall in love with a house that's just a little bit over what they would be able to afford. So let's not go down that road. Let's get set up for success from the beginning.
Yeah, absolutely. Absolutely.
Well, thank you so much, Melissa. This was some excellent information, and I'll go ahead, as always, and put Melissa's and mine's contact information in the video somewhere so that you can reach out to either one of us. And I look forward to getting some more information out there soon, Melissa.
Great. Absolutely. If anyone has any questions, by all means, comment on here or give me a call using my contact information, and I'd love to help you. Thanks for having me again, Misty.
Absolutely. Take care.